Most people who own index funds have no idea what they actually own. They picked a few funds because a coworker mentioned them, or because they sounded reasonable, or because the company they work for offered them inside the 401k. And for years, sometimes decades, their money sits in those funds while their owner has never once examined what is actually inside them. This is not a small problem. The difference between owning the right 3 index funds and owning the wrong 7 can easily amount to $200,000 or more over a 30-year investing career. Not from picking winners, not from market timing, simply from not paying hidden fees, not duplicating exposure, and not buying into the marketing of products designed to extract rather than build wealth. I am Ben. This is going to be a different kind of video. Less philosophy, more practical. By the time we are done, you will know exactly which 3 index funds belong in almost every long-term portfolio, and which 7 you should question carefully before they ever appear in yours. The rules I am about to give you are not theoretical. They flow directly from 40 years of data on what actually compounds wealth and what quietly drains it. Let us start with what an index fund actually is, because the term gets thrown around so casually that the underlying definition has gotten fuzzy. An index fund is a pooled investment vehicle that holds every stock or bond in a specific index in roughly the same proportion as that index. The S&P 500 index fund holds all 500 companies in the S&P 500. The total stock market index fund holds essentially every publicly traded American company. The point of an index fund is to be the market, not to beat it. The fund manager does not pick winners. The fund manager mechanically holds whatever the index holds. Because there is no active management, the fees are extremely low. And because no human is making decisions, there is no human to be wrong. This sounds simple. The reason it is not simple in practice is that the financial industry has spent 40 years figuring out how to package products that look like index funds, market themselves like index funds, charge fees like managed funds, and underperform almost everything. The number of products available to ordinary investors today that have the word index in the name but operate nothing, like a true index fund, is staggering. Sorting the real from the fake is the first skill any index fund investor needs. Let us start with the 3 you almost certainly need. Then we will get to the 7 that most people probably should not own. Number 1, the total United States stock market index fund. This is the foundation of nearly every well-constructed long-term portfolio. A total market fund holds essentially every publicly traded American company, weighted by market capitalization. That means the bigger the company, the larger its position in the fund. You get exposure to Apple, Microsoft, Nvidia, and the other giants at the top, but you also get every mid-cap and small-cap company beneath them. The most common version of this is Vanguard's VTI, the iShares ITOT, or Schwab's SCHB. They all do essentially the same thing. The expense ratios are negligible, typically around 3 or 0.04% per year. For every $10,000 you have invested, you pay maybe $3 or $4 annually in fees. Compared to actively managed mutual funds that charge 1% or more, the savings compound enormously over decades. Here is why the total market fund matters more than the famous S&P 500 fund. The S&P 500 holds only the 500 largest American companies. The total market fund holds about 4,000. That extra exposure to mid-cap and small-cap stocks is where historical outperformance has come from in many periods. Small-cap value, in particular, has historically outperformed large-cap growth over 20-year periods, though it has lagged badly over the past decade. Owning the total market means you do not have to predict which segment will lead next. You own all of it. Number 2, the International Developed Markets Index Fund. This is the one that almost no American investor has enough of. The most common version is Vanguard's VXUS or the iShares IXUS. These funds give you exposure to companies in Europe, Japan, Australia, Canada, and other developed economies outside the United States. Companies like Nestle, Toyota, Samsung, ASML, Novo Nordisk, Shell. These are world-class businesses that generate enormous profits and pay substantial dividends. And yet, most American portfolios have essentially zero exposure to them. The reason this matters is not patriotic. It is mathematical. Over the past 15 years, United States stocks have outperformed international stocks by a wide margin. That outperformance has caused most American investors to conclude that international stocks are not worth owning. The historical data tells a different story. Over the past 120 years, there have been multiple decade-long stretches where international stocks dramatically outperformed United States stocks. The 1970s, the 1980s, the early 2000s. The assumption that the United States will always lead is exactly the kind of recency bias that destroys portfolios when conditions shift. International developed markets currently trade at substantially lower valuations than the United States market. That is not a prediction that they will outperform tomorrow. It is a recognition that you are buying at a meaningfully better starting price, which historically correlates with better long-term returns. Number 3, the bond market index fund. The most common versions are Vanguard's BND or the iShares AGG. These funds hold essentially every investment-grade bond issued in the United States, from treasury bonds to corporate bonds to mortgage-backed securities. Bonds are not exciting. They will not double your money. They will not generate stories that get told at dinner parties. What they will do is reduce the volatility of your overall portfolio and provide some stability when stocks experience the inevitable major decline. The right allocation to bonds depends entirely on your age, your time horizon, and your psychological tolerance for watching your account balance drop 40% in a single year. For someone in their 20s with 30+ years of investing ahead, 10 or 15% in bonds is probably sufficient. For someone in their 50s approaching retirement, the allocation needs to climb meaningfully higher. There is no perfect number. There is only the number that lets you stay invested through the bad years without selling at the bottom. That is the entire core portfolio. 3 funds: total United States market, international developed, total bond market. With those 3, you own essentially every publicly traded company and bond in the developed world. You pay almost nothing in fees. You require essentially no maintenance. You have an extraordinarily strong starting position from which to build everything else. Now let's talk about the 7 you should approach with skepticism. The first is the actively managed mutual fund inside your 401k that calls itself a growth fund or an equity fund and charges anywhere from 0.5 to 1.5% per year. The marketing language emphasizes professional management, careful research, market expertise. The reality, documented in countless academic studies, is that approximately 90% of actively managed funds underperform their benchmark index over 20-year periods. The fees are the primary culprit. A 1% annual fee, compounded over 30 years, consumes roughly a quarter of your total returns, not a quarter of your gains above market average, a quarter of your total ending balance. If your retirement account would have been worth $2 million in a low-cost index fund, it is worth approximately $1.5 million in an actively managed fund with the same underlying performance, simply because of fees. The lost $500,000 does not announce itself. It is extracted quietly, percentage point by percentage point over decades. The second is the target date retirement fund. This one is more nuanced because target date funds have a legitimate purpose and are dramatically better than the alternatives many people would otherwise choose. The problem is not that target date funds exist. The problem is that the standard glide path embedded in most target date funds is significantly more conservative than appropriate for someone with a long time horizon. And the fees inside many target date funds are higher than necessary. If your employer offers a target date fund with an expense ratio of 0.15% or lower, and you do not want to think about your investments at all, it is a reasonable choice. If the expense ratio is 0.5% or higher, you are paying significantly more than you need to for what is essentially a basket of underlying index funds you could buy directly for 1/4 the cost. The third is the leveraged exchange-traded fund. These products are marketed with names that suggest they multiply your returns. 2 times the daily move of the S&P 500. 3 times the daily move of the NASDAQ. They sound like an obvious way to amplify gains. They are also an extraordinarily effective way to lose money over any period longer than 1 day. The mathematical reason involves something called volatility decay, but the practical result is simple. A 2 times leveraged fund does not return 2 times what the index returns over a year. It typically returns much less, and in volatile markets, it can return dramatically less, sometimes including periods when the underlying index is positive, but the leveraged fund is negative. These products are designed for day traders, not long-term investors. The marketing rarely makes this clear. The fourth is the thematic exchange-traded fund. These are products that target a specific trend or theme. The artificial intelligence ETF, the clean energy ETF, the metaverse ETF, the cybersecurity ETF. Each of these takes a hot narrative, packages a basket of related companies, and sells the fund at fees significantly higher than broad market index funds. The problem is twofold. First, by the time a theme is popular enough to launch a fund around it, most of the easy gains have typically already been captured. The companies inside the fund are usually trading at premium valuations because everyone else has noticed the same trend. Second, themes go in and out of favor unpredictably. The cannabis ETF that was hot in 2019 lost most of its value in subsequent years. The metaverse ETF launched at the peak of metaverse enthusiasm and has performed terribly. Owning thematic funds means concentrating your bets on narratives, paying premium fees for the privilege, and hoping the theme remains in favor longer than the market expects. The fifth is the single country emerging markets fund. Specifically, Brazil specifically, India specifically. Each of these markets has periods of dramatic outperformance and periods of dramatic underperformance, and timing those cycles is extraordinarily difficult even for professionals. The case for emerging markets exposure is genuine, but the right way to get it is through a broad emerging markets fund that holds many countries, not by betting on whichever single country is currently fashionable. The single country fund concentrates your risk in political events, currency moves, and regulatory changes specific to one nation. The broad emerging markets fund spreads that risk across dozens of countries and lets the diversification work in your favor. The sixth is the high dividend or dividend-focused index fund. These funds market themselves on the appeal of receiving regular income from your investments. The funds hold companies that pay above average dividends. The pitch is psychologically attractive, especially for retirees who like the idea of receiving a steady stream of payments. The problem is that focusing on dividends introduces a series of biases into your portfolio. You end up overweighted in older, slower-growing industries like utilities and consumer staples, and underweighted in faster-growing sectors like technology that historically reinvest profits rather than pay them out. Over long periods, total return funds with no dividend bias have outperformed dividend-focused funds, because the companies that retain and reinvest earnings often compound faster than the companies that pay them out. If you want income from your portfolio, the right approach is to own a broad total market fund and sell shares as needed. The tax treatment is generally better, and you do not constrain your portfolio to a subset of companies chosen for an arbitrary financial characteristic. The seventh is any fund that is heavily marketed on television, in financial magazines, or on financial influencer accounts. This sounds flippant, but it is empirically grounded. The funds that get the most marketing attention are not the funds that generate the best returns. They are the funds that generate the highest fees for the firms that sponsor them. When you see a fund advertised aggressively, the question you should ask is not whether the marketing is compelling. It is who is paying for the marketing and where the money to do so is coming from. The answer is almost always the same. The marketing is being paid for by the fees you and other investors are paying inside the fund. Funds that compete on low fees do not have large marketing budgets because they have no margin from which to spend on marketing. Funds that compete on marketing have higher fees because that is how they fund the marketing. The very visibility of a fund is itself a warning signal about its cost structure. So here is the practical framework. If you are starting from scratch, build the core of your portfolio around 3 funds: the total United States market, international developed markets, total bond market. The exact allocations depend on your age and risk tolerance, but a common starting point is roughly 60% United States, 25% international, and 15% bonds. As you age, the bond allocation typically rises, and the equity allocations decline proportionally. If you already have a portfolio, your homework is to look at every fund you own and ask 3 questions. What is the expense ratio? Is it more than 0.1%? If yes, what is it actually doing that justifies the additional cost? What is inside this fund? Is it duplicating exposure I already have, or providing something genuinely additional? Is the marketing pitch for this fund based on a theme, a trend, or a story, rather than on long-term mathematical evidence? Funds that fail this honest review should be candidates for replacement with broader, lower-cost alternatives. The biggest mistake most index fund investors make is not picking the wrong fund. It is owning too many funds. 16 funds, 23 funds, funds inside the 401k, funds inside the IRA, funds inside the taxable account, none of which were chosen with reference to the others. Every fund overlaps with others. The overall portfolio ends up massively duplicating exposure to United States large-cap technology stocks because every fund holds those stocks. The investor thinks they are diversified because they own many funds. They are concentrated because all those funds own the same handful of companies. The right portfolio is almost always smaller and simpler than it currently is. 3 funds is enough for most people. 5 is sometimes appropriate. 10 is almost always too many. The cost of complexity is not just the higher fees on the worst funds. It is the confusion that comes from not understanding what you own, the difficulty of rebalancing when allocations drift, and the cognitive load of monitoring a portfolio that does not need monitoring. The last thing I want to say is about the psychological dimension. Owning the right 3 funds and ignoring the noise about everything else is genuinely difficult. The financial industry exists to sell you complicated products. The financial media exists to fill time with discussion of those products. Your colleagues, your relatives, the people you encounter socially will all have stories about a fund that did extraordinarily well last year, or a sector that is about to take off, or a manager who has cracked some special code. The willpower to hold 3 funds and not chase the new shiny thing is the willpower that separates the people who quietly build wealth from the people who quietly transfer their wealth to fund managers. 3 funds, total market, international, bonds. That is it. Most of what you have been sold on top of that is not adding value. It is extracting it. Now you know which is which. Let me give you one more practical layer that almost nobody talks about. Where you hold these 3 funds matters almost as much as which 3 funds you own. The tax treatment of the same fund inside different account types is dramatically different and affects your real returns by a meaningful amount over decades. If you have a 401k or a traditional IRA, those accounts grow tax deferred. You pay no tax on dividends or gains while the money sits there. This makes those accounts the right place to hold your bond fund and any actively traded positions, because the regular interest and turnover would otherwise generate substantial annual taxes in a regular account. If you have a Roth IRA or Roth 401k, those accounts grow tax-free forever. This makes them the right place to hold your highest expected return positions, typically your stock index funds, because all that future growth never gets taxed. If you have a taxable brokerage account, that is the right place to hold tax-efficient holdings like a total market index fund, which generates very low taxable distributions because of how it is structured. Putting the same 3 funds in the right account types can add 0.25% or more to your real after-tax returns every single year. Over 30 years, that 0.25% compounds into tens of thousands of additional dollars. It costs you nothing to optimize this. It just requires being intentional about which fund goes into which account when you are buying. Most people get this wrong by accident. Now you know the right answer.